markets are so complacent. The future, you look at any investment bank or broker analysis on anything, there's no correction, for goodness knows, well, at least no correction before 2030, and some say no correction before 2040. I mean, everything has been priced in for the perfect world. And the world is not perfect, as we've been talking about. So at the moment, the geopolitical crisis is not being reflected in stock markets. What's going to change it? First of all, if you look beneath the hood, America's economy is actually weakening quite rapidly, whether it be on consumer spending, whether it be in housing, whether it be in retail sales, or whether it be in employment. And the market reflects what is announced on GDP. But if you look at gross domestic investment, which is supposed to marry up to what the GDP data says, it doesn't. There's a massive gap. GDI last year rose by only 0.5%, not 2.5%. In the first quarter, I don't yet have the exact figure, but it was significantly below the announced GDP figure. And then if you look at the inflation numbers, they're all hogwash. If you go back to how the CPI was worked before Arthur Burns in the 1970s started playing around with the compilations, today's GDP, which was followed up by successive administrations. But if you go back to the original workings, CPI today is around 12%. And then if you look at the survey, which a group called the Chapwood Group does twice a year, where they survey 500 common items in 50 different towns and cities. The last survey showed prices rising by 10%. So forget 3%. And then if you look at the number of restaurant chains shutting down, it's phenomenal. So what I'm saying is, to repeat what Danielle D. Martina Booth, who's a real expert on all of this, says, actually, once the official data is released, we will find that America actually entered a recession in October last year. So what I'm saying is, if we're not in recession now, we are on the verge of it, and that over the next couple of months, we will see the official data being significantly revised down to the point that markets realize, oh, things are not that good, and that we are in recession. Problem, and that's not only reflective in America, but in America too. All the manufacturing surveys are very negative, and even some of the regional bank surveys in the last month showed a very significant drop. And in Europe, manufacturing is still in recession. Services have improved, but I maintain that reflects the strength of equity markets. And when equity markets start falling, so will the services. And in China, business, other than in a few selective sectors, is very weak. And you can see it in the physical base metal sectors, very weak, confirmed by chats I had this morning in China. In Japan, question mark, how strong is the economy? So if, as I expect, that there will be a geopolitical shock, probably before October, that's going to create big corrections in equity markets globally. I think we are in the point of seeing the last 5% rise in most of the American indices, whether it be S&P, the Dow, or the FANGs index. And then if you look at the banking index, the KMB index, it looks shockingly weak, suggesting that we've got more bank failures to come in the second half of the year, and probably more corporate failures too, and bigger ones. Don't forget, all we've seen so far has been the low-hanging fruit that have failed. The bigger fruit higher up the tree takes longer for the rise that we've seen of about 5 percentage points in interest rates to work their way through the bigger companies and banks. But I think that the second half of this year, that's what we're going to see. So at the same time, the Fed is in a quandary. Inflation is ticking up. They know what's coming down the pipe. And on the other hand, they see weakening employment. My personal guess, nothing more than that, is that we won't see any cut in Fed interest rates until the early months of next year, when there is a different administration. I didn't say a new one, I said a different one. And that is when I think that both the Fed and other central banks will unleash huge monetary stimulus at the same time that governments take up the cudgel as well with more fiscal stimulus, which then leads us into the dollar becoming very weak, inflation surging, particularly food and energy prices, and it will lead to a recovery in business activity, but inflationary driven. What does that mean? It means that households see inflation rising, so they buy more than their current consumption. What does manufacturing do? It does the same thing. It increases its stocks of everything because they see a falling dollar and they see rising inflation. So what we will then see, where are we now, 24, 25? We will see in the second half of 26, probably, possibly early 27, in global inflation, probably 15% plus, US inflation 13% plus, what we saw in 1981-82. And what do the bond vigilantes say? They will hate that scenario. Long bonds will rise sharply. We have long bonds probably by the end of 27, if not earlier, over 10%, well over 10%. What does that do to a highly indebted system? Crash. So we expect to see, at best, rolling recessions for 5 odd years and perhaps depression before we finally get out of the quagmire. Debt will have been washed out, and we will then have 20, 30 years of sound, equitable growth, not driven by debt. There's one factor I've not mentioned, which one should, is the imposition of central bank digital currencies, which is probably coming. But before that can happen, the banking system has got to be shut down. So whether that happens as a result of a cyber attack by Russia/China, or whether it happens by their own intelligence services doing it in order to shut the banking system down, and when reopened, introducing central bank digital currencies. I think what saved us from having a recession last year was the fiscal stimulus. The real data is pointing towards recession. My advice is don't look on the jump in copper prices as being reflective of the fundamentals. It was virtually entirely driven by the funds and banks causing a huge squeeze on COMEX futures, nothing to do with the fundamentals. Global physical consumption is weak, and the global copper fabricators are only expecting physical consumption to grow by less than 1% this year. There are supply problems. Short term, I think they've been magnified. So certainly in the first quarter, the published data is showing there was a surplus. So I think that what we are going to see with physical consumption remaining in the doldrums and probably getting worse in the second half of the year as recession gathers pace, you have a big correction in equity markets, maybe 30 to 40%. That's going to unwind a lot of the spec long positions held by funds, etc. So we would expect copper prices by early next year to be under $7,000. Then, when the banks and the governments prevent any big systemic failure by pumping up the system again, then we will get prices at least doubling within 2 years to $14,000. I mean, the history of copper is such, it's part of the macroeconomy. Prices above $10,000 lead to substitution. It's already happening in EVs. The world's biggest producer of wiring for EVs in particular, actually told an industry conference a year ago that 40% of copper used in wiring for EVs will be replaced by aluminium. And I mean, the bigger usages for transmission cables, low voltage underground cables, have already, over the years, you've seen less and less being used. You get for copper prices over 10,000, there will be a jump to using aluminium. So it's not a one-way street, which so much of the investment community believes copper is. It's a two-way street, as it always has been. End of story. The gold price is a reflective of the weakness of the financial system and the geopolitical disturbances that are occurring. The East has been the big buyer of gold. The West has been a seller. Now the West is finding that maybe we've been wrong and that we should be increasing our share of gold to our dollar reserves. In China, ever since the Shanghai Gold Exchange was opened, I think it was in 2002, Chinese households and institutions have bought something like 23,000 tons from the exchange. Where are we now? About 6 months ago, the PBOC created a system whereby households can buy physical gold from the Shanghai Gold Exchange through their bank accounts, and in fact, even on an installment basis. It's also interesting that gold is being used in some cases as the instrument of creating, for instance, India to buy enough rubles in order to pay for their oil imports. And at least between Russia and China, with Russia holding a large trade surplus, it is gold being held in the PBOC that acts as the differential account. I think that's what we're going to see more of, which is that in one form or another, within the growing BRICS community of nations, that gold will be part of their monetary system. And it's likely that the BRICS membership will rise from 10 today to 40 within 2 to 3 years' time. Then BRICS group of nations will be accounting for over half of the world's population and GDP, whereas at the moment it's only just under 30%. Don't ask me what the price will be. I'm not clever enough to answer that, but it'll be much higher than today.